There's a company that owns a piece of everything you touch today. Your iPhone? They own 7% of Apple. Your morning coffee from Starbucks? They own 6%. The gas you pumped? ExxonMobil? They own it. Your Netflix subscription? Yep. Your Amazon package? Them too. Microsoft, Google, Facebook, Tesla, McDonald's, Walmart, your bank, your insurance company, probably even the chair you're sitting on right now. One company has its fingers in all of it. They control $10 trillion. Not million, not billion, trillion with a T. That's more money than the entire economy of every country on Earth except the United States and China. It's more than the GDP of Japan, Germany, and the United Kingdom combined. 3 times more than Jeff Bezos, Elon Musk, and Bill Gates have made in their entire lives, combined. And I'd bet everything I own that you've never heard their name. They're not flashy. No Super Bowl commercials, no celebrity CEO doing podcast tours, no scandal-filled headlines. They operate in complete silence, moving markets with a single algorithm, controlling boardrooms without making a sound, shaping government policy while remaining invisible to 99% of the population. But what nobody knows is how they got there. The crisis that birthed them, the secret technology that powers their empire, the revolving door between their offices and the White House, the reason why some call them the most dangerous company in America. This isn't a conspiracy theory. This is documented, verified, and absolutely terrifying when you understand the scale. This is the story of BlackRock, the $10 trillion shadow that controls modern capitalism, the firm that's bigger than most governments, more powerful than most nations, and completely unknown to almost everyone. By the end of this video, you'll never look at the stock market the same way. You'll never see corporate America the same way, because once you see who really pulls the strings, you can't unsee it. Let me show you how 8 guys in a conference room built the most powerful company you've never heard of. Larry Fink is worth over $1 billion today, but that number doesn't capture even a fraction of his real power. He doesn't just control his own wealth. He controls $10 trillion of other people's money. He decides which companies get funding and which ones die. He influences climate policy for the entire planet. He has a direct line to every president, regardless of party. Central banks call him during financial crises. When Larry Fink speaks, the entire global economy listens. Yet in 1988, he was just another Wall Street casualty, 35 years old, just lost his firm $100 million in a single quarter. Career seemingly over, reputation destroyed, every headhunter in New York avoiding his calls. The gap between those two realities is staggering. How does someone go from being fired for catastrophic losses to controlling more money than has ever existed in human history? How does a company nobody's heard of become more influential than Goldman Sachs, JP Morgan, and Morgan Stanley combined? The answer lies in something most people will never understand. A technology so powerful that governments, corporations, and billionaires pay billions just to access it. A system that can predict market crashes before they happen, value any asset in the world in seconds, and manage risk at a scale that was previously impossible. What made BlackRock different wasn't just ambition, it wasn't connections, though they had those. It wasn't even money, though that came later. What made them different was that they built a machine, a genuine technological advantage in an industry that still relied on gut feelings and handshake deals. Let me paint you a picture of 1988. The Cold War was ending. The Berlin Wall would fall within a year. Personal computers were just starting to appear in offices. The internet as we know it didn't exist. Cell phones were the size of bricks and cost $4,000. Most financial trading still happened by phone and paper. Wall Street was dominated by old money, firms that had been around for a century, partnerships passed down through generations. The culture was martinis at lunch, golf on Thursdays, promotions based on whose father you knew. Technology was viewed with suspicion. Real traders relied on instinct, relationships, and reading the room. Into this world stepped Larry Fink and 7 other guys who'd just gotten burned by the old way of doing things. They were quants before quant was cool. Math nerds in an industry run by smooth-talking salesmen. They believed that risk could be measured, predicted, and managed with computers and algorithms. Wall Street laughed at them. Banks wouldn't take their calls. Investors thought they were crazy. Why would anyone trust a computer over a seasoned trader with 30 years of experience? How could an algorithm understand the human element of markets? Technology was fine for back-office stuff, but real money, real decisions, that required the human touch. Behind the skepticism was something deeper, though. Something that nobody talks about, but everyone in finance understood. The old system worked great if you were already on top. The old boys club didn't want disruption. They didn't want transparency. They definitely didn't want some computer system showing exactly how much risk they were taking on, how poorly they were actually performing, or how many of their expert decisions were just lucky guesses. BlackRock threatened all of that. They promised to show exactly what was in every portfolio, measure every risk, track every trade, and do it all with mathematical precision. No more hiding bad bets, no more creative accounting, no more trusting the guy because he went to Yale with your dad. The establishment wanted them to fail. What they didn't anticipate was that the world was about to change, that a series of financial disasters was about to prove that the old way was broken, that technology wasn't just useful, it was absolutely necessary for survival. But to understand how BlackRock conquered Wall Street, how they became more powerful than the firms that rejected them, how they quietly took over the global financial system while nobody was watching, we need to go back to where it really started. Not in 1988 when BlackRock was founded, but 1 year earlier, October 19th, 1987, the day that destroyed Larry Fink's career and planted the seed for the most powerful financial empire in history. The day Wall Street calls Black Monday. Chapter 1. Humble Beginnings. Before BlackRock, before the power, before the $10 trillion, there was just Larry Fink sitting in an office at First Boston, watching his entire career implode in real time. October 1987. The stock market was flying high. The Dow Jones had gained 40% that year alone. Traders were making money hand over fist. Bonuses were massive. Cocaine was flowing through Wall Street like water. Everyone thought they were geniuses. Larry Fink was running the mortgage-backed securities division at First Boston. He was good at his job. Really good. He'd helped create the entire mortgage-backed securities market, a new way for banks to package home loans and sell them to investors. It was innovative, it was profitable, and it was about to blow up in his face. Here's what happened. Fink and his team had been buying mortgage bonds like crazy. The strategy was simple. Borrow money at low short-term interest rates, use it to buy mortgage bonds that paid higher long-term rates, pocket the difference. Free money. Everyone was doing it. But there was a problem nobody wanted to talk about. This strategy only worked if interest rates stayed stable or went down. If rates went up, you'd be paying more to borrow than you were earning on the bonds. And if rates went up fast, you'd be completely destroyed. In 1987, rates started climbing, fast. Fink's portfolio started bleeding, not slowly, not manageably, catastrophically. By the end of the quarter, First Boston had lost $100 million on his watch. In 1987, money, that's about $270 million today. His bosses were furious. His reputation on Wall Street was finished. At 35 years old, his career in finance appeared to be over. You see, what killed Fink wasn't that he made a bad bet. Lots of traders make bad bets. What killed him was that he didn't even know how bad the bet was until it was too late. He couldn't measure his risk. He couldn't see it coming. He trusted gut feeling and conventional wisdom instead of data. The experience broke something in him, or maybe it built something new. While other traders blamed bad luck or market conditions, Fink became obsessed with a different question. What if we could measure risk exactly? What if we could see every scenario, stress test every position, know precisely what would happen if rates moved, if markets crashed, if any variable changed? What if we never had to guess again? He started having conversations with other people who'd been burned the same way. Robert Capito, who'd worked with him at First Boston. Susan Wagner, a brilliant analyst who understood that the old Wall Street Boys Club was holding back innovation. Ralph Schlossstein, who had government connections. Barbara Novick, who understood the legal and regulatory side. Ben Golub and Keith Anderson, math PhDs who could actually build the technology. These 8 people started meeting in secret, not at fancy restaurants. In conference rooms and coffee shops, sketching ideas on napkins, building financial models on early computers, asking themselves what a financial firm would look like if it was built from scratch with technology at its core. Nobody was offering them jobs. Nobody was begging them to start a fund. They had no money, no clients, no reputation anymore. What they had was a shared belief that Wall Street was broken and they could fix it. The plan was radical for 1988. They wouldn't be traders trying to beat the market. They wouldn't make big bets with their own money. They'd be risk managers, helping other people understand and manage their investments. They'd build a computer system that could analyze any security, any portfolio, any market condition, and tell you exactly what your risk was. Risk management. It sounds boring. It sounds like the least sexy thing you could possibly do on Wall Street. But that was the genius of it. Every bank, every pension fund, every insurance company in the world was holding billions in assets they didn't fully understand. They were flying blind. After Black Monday, after watching the market crash 22% in a single day, everyone was terrified it would happen again. They desperately needed someone who could tell them if their portfolios were safe. Fink and his team would be that someone. They'd sell certainty in an uncertain world. But first, they needed money to build the technology. They needed an investor crazy enough to fund 8 guys with a destroyed reputation and an unproven idea. They found him in Steve Schwarzman, the co-founder of a little private equity firm called Blackstone. Schwarzman agreed to give them $5 million in office space in exchange for 50% ownership. The deal was simple. Blackstone would own half. The 8 founders would split the other half. They'd operate under the Blackstone umbrella, but have complete independence. On paper, this looked like Schwarzman was taking all the risk, funding some disgraced trader's wild idea about computer-driven risk management. In reality, Schwarzman was making the bet of a lifetime. He just didn't know it yet. They needed a name, something that sounded strong, solid, trustworthy. They were part of Blackstone. They managed assets. Someone suggested BlackRock, keeping the black connection to their parent company, adding rock for stability and strength. It was perfect, strong, memorable, serious. In February 1988, BlackRock officially opened for business. 8 people, 1 computer system they were still building, 0 clients, and a mission to revolutionize how the financial world managed risk. Their first break came from an unlikely place. General Electric's pension fund needed help. They had billions in assets and no idea how much risk they were actually taking. They'd heard about these guys at Blackstone who were building some kind of magic risk analysis system. Fink and his team dove in. They analyzed every security GE held. They ran stress tests. They showed GE exactly what would happen to their portfolio in dozens of different scenarios. Market crash? They could measure it. Interest rate spike? They could quantify it. For the first time, GE could actually see their risk instead of guessing at it. GE was impressed, really impressed. They didn't just become a client. They became evangelists, telling other pension funds and corporations about these risk management wizards at BlackRock. More clients started calling, not the flashy hedge funds or investment banks, the boring money, pension funds, insurance companies, college endowments, organizations that couldn't afford to take big risks because they were managing money that belonged to retirees, policyholders, students. This was the foundation of everything that would come later. While other Wall Street firms were chasing quick profits and big bonuses, BlackRock was quietly building relationships with the most stable, long-term money in the world. But the real breakthrough, the thing that would make them unstoppable, was still being built in the background. A computer system unlike anything Wall Street had ever seen. A risk management platform that would become more valuable than gold. They were calling it Aladdin, and it was about to change everything. Chapter 2. Black Monday. To understand why BlackRock became unstoppable, you need to understand October 19th, 1987. Black Monday. The day the market fell off a cliff and proved that everything Wall Street believed about risk was completely wrong. The morning started normally enough. Traders arriving at their desks, coffee brewing, the opening bell is about to ring. The market had been shaky for a few days, but nothing catastrophic. Some people were nervous, most weren't. Then the selling started. Not normal selling, not profit-taking or portfolio rebalancing. Panic. Pure, unfiltered terror translated into market orders. Everyone was trying to sell at the same time. Nobody was buying. Prices were falling so fast the ticker couldn't keep up. By 10 a.m., the Dow Jones was down 10%. Trading floor chaos. Phones ringing non-stop. Clients screaming, partners shouting, the whole system breaking down in real time. By noon, down 15%. Computer systems were crashing. Paper tickets were piling up faster than anyone could process them. Some brokers just stopped answering phones because they had no idea what anything was worth anymore. By market close, the Dow had crashed 22.6% in a single day. Not a week, not a month. One day, $508 billion in market value vanished. Gone. Erased. Pension funds destroyed. Portfolios cut in half. Decades of gains wiped out between breakfast and dinner. It was the largest single-day percentage decline in stock market history. Worse than the 1929 crash that started the Great Depression. Worse than anything that had happened before or has happened since. But here's what most people don't understand about Black Monday. It wasn't just a bad day. It was proof that the entire foundation of modern finance was built on sand. All the sophisticated models that banks used to measure risk, useless. They assumed markets moved in predictable ways, that volatility had limits, that crashes like this were mathematically impossible. The models said a 22% single-day drop had a probability so low it should never happen in the lifetime of the universe. Yet it happened on a random Monday in October. All the circuit breakers and safety systems that were supposed to prevent crashes, they made it worse. Program trading, computers automatically selling when prices dropped, created a feedback loop. Selling triggered more selling, which triggered more selling. The machines couldn't stop themselves. All the experts who said they could see crashes coming, they were blindsided. Nobody predicted it. Nobody got out in time. The smartest people on Wall Street lost billions because they trusted systems that didn't work. Larry Fink watched this unfold from his desk at First Boston. His portfolio was already bleeding from rising interest rates. Black Monday made it exponentially worse. The bonds he held plummeted in value. The models he'd relied on were clearly broken. Everything he thought he knew about risk management was wrong. Most traders responded to Black Monday by doubling down on their old methods. They blamed program trading or foreign markets or Federal Reserve policy. They convinced themselves it was a once-in-a-lifetime event that would never happen again. They went back to trusting their gut and making big bets. Fink responded differently. He became obsessed with building something better. You see, the real lesson of Black Monday wasn't that markets are unpredictable. It was that the tools everyone was using to predict them were garbage. The models were too simple. The data was insufficient. The technology was primitive. But it didn't have to be that way. What if you built a system that didn't assume markets behaved rationally? What if you stress-tested every position against every possible scenario, including the supposedly impossible ones? What if you had real-time data on every security, every market, every economic indicator in the world? What if you built a risk management system that actually worked? This became Fink's mission. When he started BlackRock 6 months after Black Monday, this idea was baked into the company's DNA from day one. They weren't trying to beat the market. They were trying to make sure their clients never experienced another Black Monday surprise. The pitch to potential clients was simple and powerful. Remember Black Monday? Remember how you felt watching your portfolio collapse and realizing you had no idea it was coming? We're building a system that will make sure you always know exactly what you're holding and what could go wrong. It resonated. Pension fund managers who'd watched their retirees' money evaporate were desperate for better tools. Insurance company executives who'd been blindsided by losses wanted early warning systems. College endowment directors who had to explain devastating losses to their boards needed better risk management. BlackRock offered them something Wall Street had never provided before: honesty. Total transparency into what they owned and what could happen to it. The competition didn't take them seriously at first. The big Wall Street firms thought risk management was boring, unsexy, low margin. Why waste time telling clients about risks when you could be making huge trades and collecting massive fees? What they missed was that Black Monday had fundamentally changed the game. The old cowboy mentality of taking big risks for big rewards, it didn't work anymore. Regulators were cracking down. Clients were demanding accountability. The era of "trust me, I'm a genius trader" was over. The era of "show me the data and prove the risk is manageable" had begun, and BlackRock was the only firm actually built for this new world. But selling risk management services alone wouldn't build an empire. Fink understood this. The real prize wasn't charging fees for analysis, it was managing the money itself. If you could prove you understood risk better than anyone else, clients would eventually give you their money to manage. That was the long game: build the best risk management system in the world. Use it to prove you're smarter than everyone else. Then slowly, methodically, convince clients to let you actually manage their portfolios instead of just analyzing them. The strategy required patience. It required building trust over years, not months. It required doing boring, unglamorous work while the flashy hedge funds and investment banks grabbed headlines. But Fink had time. He'd learned the hard way that slow and steady beats boom and bust. He'd rather build something that lasted decades than make a quick fortune and flame out. What nobody realized yet, not the big banks, not the competitors, not even most of BlackRock's own clients, was that the risk management system they were building wasn't just good. It was revolutionary. It was going to become the foundation of a $10 trillion empire. They called it Aladdin. Asset, liability, debt, and derivative investment network. The name was cute. The power behind it was anything but. Aladdin was supposed to be BlackRock's internal tool, a way for their own analysts to manage client portfolios and measure risk. But as they built it, as they added more features and more data and more computing power, something remarkable happened. They created something that every major financial institution in the world would eventually need. A system that could analyze any security that existed, in any market, in any currency, under any conditions. A platform that could value trillions of dollars in assets in seconds. A tool that could see risks that human analysts would miss. Here's what's interesting. Aladdin started as a solution to Larry Fink's personal trauma from Black Monday. A way to make sure he never again lost $100 million because he couldn't see risk clearly. It became his competitive advantage, the reason BlackRock was better at managing money than anyone else. But the real genius move. Fink realized that Aladdin was valuable not just for managing money, it was valuable for anyone who needed to understand risk, which meant almost every major financial institution on Earth. What if BlackRock didn't just use Aladdin themselves? What if they licensed it to other firms? What if they sold their technological advantage to their competitors? It sounds counterintuitive. Why would you give away your secret weapon? But Fink understood something profound. The more firms that used Aladdin, the more data BlackRock would have. The more data they had, the smarter the system would become. The smarter it became, the more valuable it would be. And here's the kicker. If everyone on Wall Street was using BlackRock's system to measure risk and value securities, BlackRock would essentially be able to see the entire market's positions in real time. They'd know what everyone owned, what risks they were taking, what they were buying and selling. That's not just a competitive advantage, that's market omniscience. But I'm getting ahead of the story. In the early 1990s, Aladdin was still being built. BlackRock was still small, still relatively unknown, still fighting for every client. The transformation from scrappy startup to unstoppable empire was about to begin. And it would start with a crisis that made Black Monday look like a minor hiccup. Chapter 3. The algorithm. Let me explain what Aladdin actually does, because this is the key to understanding how BlackRock became the most powerful financial company in history. Imagine you're managing a pension fund with $50 billion in assets. You own thousands of different stocks, bonds, derivatives, real estate investments, private equity stakes, commodities, foreign currencies. Your portfolio is so complex that no single human being can hold it all in their head. Now someone asks you a simple question. What happens to this portfolio if interest rates rise by 1%? Before Aladdin, answering that question would take a team of analysts weeks. They'd have to manually calculate how each security would react. They'd have to account for correlations between assets. They'd have to model cascading effects. By the time they finished, the market would have moved, and their analysis would be outdated. With Aladdin, you get the answer in seconds. Not an estimate, not a rough guess. An exact calculation based on real-time data, historical patterns, and sophisticated mathematical models that account for thousands of variables simultaneously. That's just scratching the surface of what it can do. Aladdin can stress test your portfolio against any scenario you can imagine. Global recession, nuclear war, oil price spike, European debt crisis, currency collapse. Zombie apocalypse? Type in the parameters and Aladdin will tell you exactly what would happen to your $50 billion. It can identify hidden risks that humans would never spot. Maybe you think your portfolio is diversified, but Aladdin notices that 15 of your supposedly unrelated investments all have exposure to the same obscure credit default swap. You're not diversified at all. You're concentrated in a risk you can't even see. Aladdin sees it instantly. It tracks every trade, every transaction, every cash flow in real time. You never lose track of what you own. You always know your exact exposure to any asset class, any geography, any sector, any currency. Complete transparency, updated every millisecond. It handles compliance automatically. Different countries have different regulations about what institutional investors can hold. Aladdin knows all of them and makes sure you never accidentally violate a rule that could cost you millions in fines. It optimizes portfolios algorithmically. Tell Aladdin your target return and maximum acceptable risk, and it will recommend exactly what you should buy and sell to achieve those goals. Not based on human intuition or market rumors, based on mathematical optimization across millions of possible scenarios. Most importantly, it gets smarter over time. Every portfolio it manages, every trade it processes, every risk calculation it runs, all of that data feeds back into the system, making the algorithms more accurate, the predictions more reliable, the risk assessments more precise. When BlackRock first built Aladdin in the early 1990s, it was impressive. Today, after processing trillions of dollars in trades over 30 years, after integrating data from thousands of institutions, after continuous improvements and upgrades, it's not just impressive, it's irreplaceable. Think about what this means strategically. In the 1990s, while other investment firms were hiring more traders and analysts, BlackRock was investing everything into building better technology. Everyone else was scaling humans. BlackRock was scaling silicon and software. Human analysts get tired, they make mistakes, they have biases and emotions. They can only process so much information. They're expensive to hire and train. And most importantly, they don't scale. If you want to manage twice as much money with human analysts, you need to hire twice as many analysts. Aladdin never gets tired. It doesn't make emotional decisions. It can process infinite amounts of information simultaneously. Once it's built, the marginal cost of analyzing one more portfolio is essentially zero, and it scales effortlessly. Managing $10 billion requires the same amount of computing power as managing $10 trillion. This is why BlackRock could grow so explosively. They weren't constrained by human capital. As they took on more clients and more assets, they didn't need to massively expand their workforce. Aladdin could handle the load. Their competitors were stuck in the old model, drowning in complexity as they grew. BlackRock just plugged new portfolios into Aladdin and let the algorithm do the work. But the real genius move, the thing that separates BlackRock from every other tech-forward financial firm, was Larry Fink's decision to license Aladdin to other institutions. Starting in the mid-1990s, BlackRock began selling access to Aladdin to banks, insurance companies, pension funds, and even competitors. At first, Wall Street thought Fink was crazy. Why would you sell your technological advantage to your rivals? Why would you teach them your methods? Fink understood something nobody else saw. The value of Aladdin wasn't just in having it. The value was in the data that flowed through it. Every firm that used Aladdin was essentially feeding their portfolio data, their trades, their risk calculations back to BlackRock. Not because they were naive, the contracts spelled it out clearly, but because the benefits of using Aladdin outweighed the costs of sharing information. Consider this. By 2010, Aladdin was being used to manage over 7% of the world's financial assets. That's not just BlackRock's own assets under management, that's all the other firms and institutions that license the platform. Aladdin was processing over $3 trillion in trades every single day. What does this mean? It means BlackRock could see positions and risks across the entire financial system. They knew what the big banks were holding. They knew what pension funds were worried about. They knew where the hidden concentrations of risk were building up. They had a god's-eye view of the global financial system that nobody else possessed. Now, BlackRock is very careful to say, that they keep client data confidential, that they don't use the information from Aladdin licenses to gain unfair advantages. I'm sure their lawyers have drafted those policies very carefully, but think about it logically. Even if they're not looking at specific client positions, the aggregate data flowing through Aladdin gives them insights that are impossible to get any other way. They can see trends before they become obvious. They can spot vulnerabilities before they become crises. They can position their own portfolios based on a level of market intelligence that borders on omniscience, all completely legal, all completely within the rules. Just by having built the best risk management system in the world and convinced everyone else to use it. This is the moment BlackRock stopped being just another investment firm. This is when they became infrastructure. They weren't competing in the financial system anymore. They were becoming part of the operating system that ran the financial system. Let me give you a specific example of why this matters. In 2007 and 2008, the global financial system nearly collapsed. Banks that had existed for over a century went bankrupt overnight. The entire economy came within hours of complete meltdown. Almost nobody saw it coming. Almost. BlackRock saw it coming. Not because Larry Fink is psychic, because Aladdin could see the risks building up in the system. The overexposure to subprime mortgages, the complex derivatives that nobody understood, the interconnections that meant if one bank failed, everyone would fail. Aladdin mapped all of it. BlackRock quietly reduced their exposure to the riskiest assets. They didn't make any splashy announcements. They just used Aladdin's analysis to position their portfolios more conservatively than their competitors. When the crisis hit, they were hurt. Everyone was hurt. But they survived better than almost anyone else. Better yet, when the crisis peaked and the government was desperately trying to figure out how bad things were and what to do about it, who did they call? BlackRock. Because BlackRock had Aladdin, and Aladdin was the only system in the world that could actually analyze the toxic assets that were destroying bank balance sheets. The Federal Reserve hired BlackRock to help manage the bailout. The Treasury Department hired BlackRock to value the assets they were buying from failing banks. Foreign governments hired BlackRock to analyze their own financial systems. Suddenly, BlackRock wasn't just an investment firm. They were the trusted advisor to the most powerful institutions on Earth. This is what Aladdin bought them. Not just better investment returns, not just operational efficiency, but trust and influence at the highest levels of power. When the chips were down and the global economy was on the brink, the people who controlled the printing presses and the nuclear codes called BlackRock for advice. Think about what that means. The government's response to the financial crisis, which companies got bailed out, which ones were allowed to fail, what assets were purchased, what regulations were changed, was shaped in part by BlackRock's analysis. An analysis performed by Aladdin, a private system owned by a private company that now had unprecedented influence over public policy. Was it corrupt? No, BlackRock's analysis was probably the most accurate available. Was it concerning? Absolutely. One company shouldn't have that much influence over government decisions that affect everyone. But this is the world Aladdin created. A world where BlackRock's technological advantage translated into political power, where their ability to understand risk better than anyone else made them indispensable to governments and regulators, where they stopped being a market participant and started being something closer to market infrastructure. By 2010, Aladdin was managing over $10 trillion in assets across more than 200 institutions in 30 countries. Not just processing trades, actively managing portfolios, assessing risks, making recommendations that moved markets, all connected back to BlackRock's servers, all feeding data back into the mother brain. The competitors who'd laughed at Fink's nerdy focus on technology weren't laughing anymore. They were panicking because they'd woken up to realize that while they were hiring more investment bankers and traders, BlackRock had built the matrix. They were living in BlackRock's world now, playing by BlackRock's rules, using BlackRock's tools, and paying BlackRock billions for the privilege. The algorithm had won, the machines had conquered Wall Street, and Larry Fink, the guy who got fired for losing $100 million, was now the most powerful person in finance. Not because he was the richest, Not because he was the smartest, because he controlled the system that everyone else needed to survive, but Aladdin was just the foundation, the technology that made everything else possible. What BlackRock built on top of that foundation was even more audacious, a quiet takeover of corporate America so thorough that most people still don't realize it happened. Let me show you how they did it. Chapter 4: Silent Takeover. Here's a question most people never think to ask. Who actually owns America's biggest companies? You might say shareholders, and you'd be technically correct. But let's get specific. Who are the biggest shareholders of Apple, Microsoft, Amazon, Google, Facebook, ExxonMobil, JP Morgan, Walmart? The list goes on. The answer, overwhelmingly, is BlackRock. They're the largest or second largest shareholder in almost every major public company in America, and most of Europe, and increasingly Asia. They don't own outright majorities, that would be too obvious. But they own enough that their vote matters in every boardroom decision that matters. Check the shareholder registry of any Fortune 500 company. You'll see BlackRock right at the top, typically owning between 5% and 10% of all shares. That doesn't sound like much until you remember that most shares are held by millions of scattered individual investors who never vote or pay attention. When one entity controls 7% of a company and actually exercises those voting rights strategically, that's enormous power. Let me put this in perspective. BlackRock owns 7.5% of Apple. That's over $200 billion worth of stock in a single company. They own 7.7% of Microsoft, another $200 billion. Add up their positions in Amazon, Google, Facebook, Tesla, Netflix, Visa, MasterCard, Disney, Coca-Cola, and every other household name you can think of. The numbers become surreal. They don't just own tech companies either. They own significant chunks of every major bank. JP Morgan. BlackRock owns 6.7%. Bank of America, 7.3%. Citigroup, 7.1%. Wells Fargo, 8.5%. They own the institutions that control everyone's money. They own the retry or continue edit energy sector. ExxonMobil, Chevron, Shell, BP. BlackRock is a top shareholder in all of them. They own the pharmaceutical giants, Pfizer, Johnson & Johnson, Moderna. They own the defense contractors, Lockheed Martin, Boeing, Raytheon. They own the media companies that control the news, Comcast, Disney, Warner Bros. Discovery. When you start mapping this out, a terrifying picture emerges. There's virtually no major industry in America where BlackRock doesn't have massive ownership stakes in the biggest players. But here's what makes this truly unprecedented. BlackRock doesn't just own pieces of competing companies. They own pieces of all the competing companies in the same sector. They're simultaneously major shareholders in Coca-Cola and PepsiCo, in McDonald's and Burger King, in Delta and United Airlines, in CVS and Walgreens, in Home Depot and Lowe's. Think about what this means. If you're the CEO of Coca-Cola and you're trying to compete aggressively against Pepsi, you have to remember that your largest shareholder also owns a huge chunk of your competitor. Win too hard, and you might hurt your own shareholders' other investments. It creates a built-in incentive for less competition, higher prices, and industry-wide coordination. BlackRock didn't plan a conspiracy to take over corporate America. They don't need to. The math did it for them automatically. Let me explain how. In the 1990s and 2000s, there was a massive shift in how Americans invested. People stopped picking individual stocks. They stopped paying expensive financial advisors to manage their portfolios actively. Instead, they piled into index funds, passive investments that simply track the overall market. Index funds are beautiful in their simplicity. Instead of trying to beat the S&P 500, you just buy all 500 companies in the S&P 500 in proportion to their market capitalization. No analysis needed, no trading required, just automatic matching of the index, and the fees are incredibly low because there's almost no work involved. BlackRock recognized this trend early. In 2009, they acquired iShares from Barclays for $13.5 billion. At the time, it seemed expensive. Today, it looks like the bargain of the century. iShares is BlackRock's index fund platform, exchange-traded funds that track every index imaginable. S&P 500, International markets, bonds, commodities, real estate. If it can be indexed, iShares has a fund for it. The platform has become the largest ETF provider in the world, managing over $3 trillion in assets by itself. Here's the genius of this business model. When you buy an iShares S&P 500 fund, you're not giving BlackRock permission to pick stocks for you. You're giving them your money, and they automatically buy shares in all 500 companies. Simple, passive, cheap. But here's what happens at scale. When millions of people invest trillions of dollars in index funds, somebody has to actually hold and vote those shares. That somebody is BlackRock. The investors own the value, but BlackRock controls the votes. You see where this is going. Individual investors think they're just diversifying their retirement accounts. What they're actually doing is concentrating voting power in the hands of three giant asset managers: BlackRock, Vanguard, and State Street. These three firms now control about 20% of every public company in America. Not because they're buying companies, because passive investors are voluntarily handing them proxy voting rights. BlackRock votes on thousands of shareholder proposals every year. Board elections, executive compensation, mergers and acquisitions, corporate strategy, environmental policies, social issues, everything that determines how companies operate. And they vote with the weight of trillions of dollars behind them. Now, BlackRock will tell you they vote in the best interests of their clients. They have a fiduciary duty. They publish detailed voting guidelines. They're transparent about their process. All true. But who decides what's in clients' best interests? BlackRock does. Larry Fink does. The stewardship team at BlackRock does. This is where things get really interesting. Larry Fink started writing an annual letter to CEOs, not BlackRock's clients, the CEOs of companies that BlackRock owns shares in. At first, these letters were fairly standard stuff about corporate governance and long-term value creation, but over time, they became more ambitious, more political, more prescriptive about how companies should operate. The 2020 letter focused on climate change. Fink told CEOs that climate risk was investment risk, and that BlackRock would be voting against directors and management at companies that weren't taking climate seriously. Given that BlackRock was the largest shareholder in most of these companies, this wasn't a suggestion. It was a directive. The 2021 letter pushed further into stakeholder capitalism. The idea that companies should serve not just shareholders, but all stakeholders, including employees, communities, and the environment. Again, backed by BlackRock's massive voting power. Critics on the right accused Fink of using other people's money to push his personal political agenda. How dare he force companies to prioritize climate and social issues when investors just want returns? Critics on the left said Fink wasn't going nearly far enough, that BlackRock talks a good game on climate, but continues to invest in fossil fuels and vote against aggressive environmental proposals. Both critiques have merit. What's undeniable is that one person, Larry Fink, now has more influence over how American companies operate than almost anyone else alive. More than most politicians, more than most regulators, because he controls the votes of trillions of dollars in shareholdings. Think about the implications. Corporate America used to answer to a diffuse group of millions of shareholders with different interests and priorities. Now they effectively answer to three giant asset managers who control enough votes to determine the outcome of any corporate decision. That's an unprecedented concentration of corporate control in just a few hands. And it's not just voting power. BlackRock's ownership stakes give them access that normal shareholders don't have. When BlackRock's investment team wants a meeting with a CEO or CFO, they get the meeting. When they have concerns about strategy, those concerns get addressed. When they make suggestions, those suggestions get seriously considered, because every executive knows that BlackRock can make their life very easy or very difficult, depending on how they vote at the annual meeting. This creates a weird dynamic. BlackRock insists they're passive investors. They're not trying to run companies, just tracking indexes. But their size makes them inherently active participants in corporate governance, whether they want to be or not. They can't hide. They can't stay neutral. Every vote is a statement. Every letter from Fink is front-page news. Some academics argue this is actually good for markets. Having large, sophisticated investors like BlackRock playing an active governance role could prevent the kind of short-term thinking and excessive risk-taking that leads to corporate scandals and financial crises. Maybe we need someone looking out for the long-term health of companies. Others argue it's a fundamental threat to capitalism. Markets work because millions of independent actors make independent decisions based on their own interests. When 3 firms control 20% of everything, you don't have a market anymore. You have an oligarchy. Competition dies. Innovation slows. Power concentrates. What nobody disputes is that this situation is unprecedented. Never in history has this much corporate control been concentrated in so few hands. And it happened quietly, almost by accident, as a side effect of the shift to passive investing. Nobody voted for this. No regulator designed this system. It just emerged from millions of individual investment decisions that, in aggregate, created a massive concentration of power. By 2015, BlackRock was managing over $5 trillion. By 2020, over $7 trillion. By 2025, over $10 trillion. The growth was exponential, and with each trillion added, their influence over corporate America deepened. But corporate ownership was just one dimension of BlackRock's power. The really concerning part, the part that makes some people call them a shadow government, is their relationship with actual governments. The revolving door between BlackRock's offices and the highest levels of political power. Let me show you just how deep those connections run. Chapter 5. Puppet Masters. In March 2020, when COVID-19 shut down the global economy and financial markets were in free fall, the Federal Reserve needed to do something unprecedented. They needed to buy corporate bonds, something they'd never done before. They needed to essentially backstop the entire corporate debt market to prevent a complete collapse. Who did they hire to actually execute this unprecedented intervention in markets? BlackRock. The Federal Reserve gave BlackRock the authority to buy billions of dollars worth of corporate bonds on behalf of the US government. BlackRock got to decide which companies received this emergency support and which didn't. They were paid hundreds of millions in fees for this service. And here's the kicker. They were allowed to buy bonds in companies where they already had ownership stakes, creating obvious conflicts of interest. Critics went ballistic. You're telling me that a private investment firm that owns shares in major corporations now gets to decide which of those corporations receives government bailout money, and they get paid for it, and they're allowed to potentially boost the value of their own investments using taxpayer money. How is this not corruption? BlackRock's response was essentially, who else could do this? We have Aladdin. We have the expertise, we have the capacity to execute at this scale and speed. Yes, there are conflicts of interest, but we'll manage them carefully with internal controls. The government apparently agreed, because they kept hiring BlackRock for more and more responsibilities. This wasn't new. BlackRock's relationship with government goes back decades, but COVID exposed just how dependent policymakers had become on BlackRock's expertise and infrastructure. When the chips were down, when trillions of dollars needed to be deployed in weeks, the government didn't have the tools or knowledge to do it themselves. They needed BlackRock. Let me walk you through the revolving door because it's stunning when you see it all laid out. Mark McComb, BlackRock's chief client officer, previously worked at the Federal Reserve Bank of New York. He knows everyone in the Federal Reserve System. He understands how they think, how they operate, what they need. Brian Dees served as head of sustainable investing at BlackRock, then became director of the National Economic Council under President Biden. He went from managing BlackRock's climate investing strategy to literally setting national economic policy. In 2023, he left the White House and went back to working in finance, advising firms on their government relationships. Cheryl Mills served on BlackRock's board while simultaneously having been chief of staff to Hillary Clinton when she was Secretary of State. The connections between BlackRock and the highest levels of political power couldn't be more explicit. Stanley Fischer, vice chairman of the Federal Reserve from 2014 to 2017, then joined BlackRock as a senior advisor. He went from being one of the most powerful people in the US monetary system to advising the world's largest asset manager. Philipp Hildebrand, former chairman of the Swiss National Bank, now vice chairman at BlackRock. He literally ran Switzerland's central bank, then joined the firm that benefits from central bank policies. These aren't low-level staffers. These are the people who make the actual decisions about monetary policy, financial regulation, and government intervention in markets. And they flow seamlessly between BlackRock and government, back and forth, building relationships and sharing knowledge in ways that blur the line between public service and private profit. The pattern is clear. BlackRock hires people from powerful government positions, giving them lucrative jobs where they can leverage their government relationships and insider knowledge. Then some of those people go back into government, bringing BlackRock's perspective and priorities with them. It's a perfect closed loop of mutual benefit. Consider what this means for policy. When former BlackRock executives are sitting in the White House or Treasury Department or Federal Reserve, making decisions about financial regulation or economic stimulus or climate policy, whose interests are they serving? They'd say they're serving the public interest, and maybe they genuinely believe that, but they've been trained by BlackRock, paid by BlackRock. Their worldview has been shaped by years of thinking about markets the way BlackRock thinks about markets. Even if there's no explicit corruption, even if nobody's taking bribes or making quid pro quo deals, the intellectual capture is complete. BlackRock's framework for understanding finance becomes the government's framework. BlackRock's priorities become policy priorities, not through conspiracy, but through the natural influence that comes from providing expertise to people who need it. Let's talk about the 2008 financial crisis again, because this is where the relationship really crystallized. When Bear Stearns collapsed, when Lehman Brothers went bankrupt, when AIG nearly took down the entire financial system, the government was completely overwhelmed. They didn't have the expertise to value the toxic assets on bank balance sheets. They didn't know which institutions were savable and which were doomed. They needed help fast. They called BlackRock. Larry Fink and his team essentially became unpaid advisors to the Federal Reserve and Treasury Department. They helped design the bailout programs. They helped determine which assets the government should buy. They provided the analysis that shaped decisions worth trillions of dollars. BlackRock didn't do this out of charity. This was strategic. By making themselves indispensable during the crisis, they positioned themselves as the go-to experts for any future crisis. They proved that when things got really bad, the government needed them more than they needed the government. The payoff came in the years after. BlackRock was hired to manage the government's holdings in bailed-out companies. They were hired to value assets for the FDIC. They were hired by the Federal Reserve Bank of New York to help manage mortgage-backed securities. Hundreds of millions in fees paid by taxpayers to a private company that was simultaneously managing investments for its own profit. But the money wasn't even the most valuable thing BlackRock gained. What they gained was legitimacy, the imprimatur of government trust. When you've been hired by the Federal Reserve and the Treasury Department to help save the financial system, other clients see you differently. You're not just another asset manager, you're the firm that governments call when the world is ending. This trust translated into explosive growth. After 2008, money flooded into BlackRock. Pension funds, sovereign wealth funds, insurance companies. Everyone wanted to invest with the firm that had the government's confidence and apparently had the smartest risk management in the world. From 2008 to 2015, BlackRock's assets under management more than doubled. Not because they had exceptional investment returns, they were mostly tracking indexes. Because they had something more valuable than returns. They had credibility, they had relationships, they had influence. Now let's talk about climate policy, because this is where BlackRock's government influence becomes most controversial. Larry Fink has positioned BlackRock as a leader in sustainable investing and climate risk assessment. The annual letters to CEOs push companies to take climate change seriously. BlackRock has created funds specifically for ESG, environmental, social, governance investing. They talk constantly about climate risk as financial risk. Sounds good, right? Maybe. But look at what's actually happening. BlackRock is simultaneously one of the largest investors in fossil fuel companies. They own massive stakes in ExxonMobil, Chevron, and every major oil and gas producer. They vote against most aggressive climate proposals at shareholder meetings. They talk about climate while continuing to fund the industries causing it. Critics call this greenwashing, using climate rhetoric for PR purposes while doing very little to actually change investment behavior. BlackRock counters that they're engaging with fossil fuel companies to encourage transition rather than divesting, and that their clients' money shouldn't be used to push political agendas. But here's what's interesting from a power perspective. By positioning themselves as climate experts, BlackRock is positioning themselves to benefit from government climate policy no matter what happens. If governments mandate green investments, BlackRock has ESG funds ready. If governments subsidize renewable energy, BlackRock owns those companies too. If governments impose carbon taxes, BlackRock's risk models will be essential for valuing the impact. They're not betting on one outcome. They're positioning themselves to profit from any outcome. That's not investment strategy. That's political strategy, using their government relationships and market position to ensure that however climate policy evolves, BlackRock will be essential to implementing it. The same pattern plays out across other issues. Financial regulation. BlackRock has former regulators on staff who help design rules that, coincidentally, tend to favor large asset managers over smaller competitors. Tax policy. BlackRock has lobbyists and former Treasury officials advocating for rules that benefit index funds. Infrastructure spending. BlackRock has infrastructure investment funds ready to deploy capital. Some people look at this and see smart business strategy. Position yourself at the intersection of markets and government, build relationships with policymakers, use your expertise to shape rules in your favor. That's just how the game is played. Others see something darker. A private company that's become so large and so connected to government that it's essentially a quasi-governmental institution, but without democratic accountability. BlackRock doesn't answer to voters. Larry Fink isn't elected. Yet their influence over economic policy rivals that of elected officials. There's a term for this: regulatory capture, when the industry being regulated becomes so influential over the regulators that the regulations end up serving industry interests rather than public interests. Except with BlackRock, it's more than regulatory capture, it's institutional capture. They haven't just captured the regulators, they've become part of the regulatory infrastructure itself. The COVID response made this crystal clear. The Federal Reserve's corporate bond buying program was essentially outsourced to BlackRock. Not because BlackRock had unique expertise that couldn't be replicated, but because building that expertise inside government would take time and money, and it was easier to just hire BlackRock. This is how institutional dependencies are created. The government becomes reliant on BlackRock's tools, Aladdin, BlackRock's expertise, former employees, and BlackRock's capacity, ability to execute at scale. Once you're dependent, you can't easily break free. Switching costs are too high, the relationship becomes permanent. Think about the implications for democracy. Monetary policy is supposed to be made by central banks accountable to elected governments. Financial regulation is supposed to be designed by regulators working in the public interest. Instead, increasingly, these critical functions are being performed or heavily influenced by a private corporation whose primary obligation is to its own shareholders and clients. BlackRock would argue they're just providing services that governments request, that they have no desire to control policy, that they simply have expertise others lack, all probably true. But intent doesn't matter as much as outcome. The outcome is that a small group of people at BlackRock have influence over global financial policy that rivals elected leaders. And this is just the United States. BlackRock has similar relationships with governments around the world. They advise the European Central Bank. They work with the Bank of England. They have relationships with finance ministries across Asia and Latin America. The web of influence is global. By 2020, BlackRock wasn't just the world's largest asset manager. They were infrastructure. Essential infrastructure that governments couldn't function without during crises. That's a staggering amount of power for a private company to hold. But power always creates backlash, and the backlash against BlackRock was building. Chapter 6. Government Ties. The relationship between BlackRock and governments runs even deeper than revolving door hiring. It's about how modern monetary policy actually works, and how BlackRock has made themselves essential to that machinery. Let's start with something most people don't understand: quantitative easing. After the 2008 financial crisis, central banks around the world started buying massive amounts of bonds to inject money into the economy. The Federal Reserve bought trillions of dollars worth of treasury bonds and mortgage-backed securities. The European Central Bank did similar programs. The Bank of Japan went even further. This wasn't traditional monetary policy. Central banks had never operated at this scale before. They needed systems to track billions of transactions, value millions of securities, manage risk across entire markets. They needed technology that could handle this complexity. They needed Aladdin. The Federal Reserve hired BlackRock to help manage their quantitative easing programs, not just once as a crisis measure, but repeatedly over more than a decade. BlackRock's technology became embedded in how the Fed actually implements monetary policy. When the Fed wants to buy mortgage-backed securities, they're using BlackRock's systems to identify which securities to buy, from whom to buy them, and what price is fair. Think about what this means. The Federal Reserve is supposed to be independent. Their monetary policy decisions are supposed to be made by government-appointed officials based on economic analysis. But the actual implementation of those decisions runs through BlackRock's privately owned technology platform. BlackRock sees every trade. They see which securities the Fed is buying and selling. They see the timing, the prices, the volumes. That's information that moves markets. Information that would be worth billions to traders if they had access to it. BlackRock has all of it. Now, there are supposed to be information barriers, Chinese walls between BlackRock's government services division and their investment divisions. Compliance officers ensuring that insider information doesn't leak. Regular audits, multiple layers of control. But here's the thing about information barriers. They're only as strong as the people maintaining them, and they're all BlackRock employees. The compliance officers work for BlackRock. The auditors are hired by BlackRock. The information lives on BlackRock servers. Even with the best intentions, the potential for conflicts of interest is massive. Let me be clear, there's no evidence that BlackRock has abused this access. No smoking gun showing they used Fed information to trade ahead of markets. They're very careful about compliance, precisely because losing government contracts would be catastrophic for them. But the fact that we have to trust a private company's internal controls for something this important, the implementation of national monetary policy, is itself concerning. This is too much power concentrated in private hands. The European situation is even more interesting. When COVID hit in 2020, the European Central Bank launched emergency bond buying programs worth over €1 trillion. They hired BlackRock Financial Markets Advisory to help design and implement these programs. This caused a huge controversy in Europe. Members of the European Parliament demanded investigations. How could a private American company be given this much control over European monetary policy? What conflicts of interest existed? What were the terms of the contracts? The ECB defended the decision the same way the Federal Reserve did. BlackRock has unique expertise. No one else can execute at this scale. The systems and knowledge simply don't exist elsewhere. Better to hire BlackRock with proper safeguards than to try to build capabilities from scratch during a crisis. This response reveals something important. Central banks have allowed themselves to become dependent on BlackRock. Whether through deliberate strategy or gradual drift, they've outsourced critical capabilities to a private vendor. Now they can't easily bring those capabilities back in-house even if they wanted to. This is a pattern you see throughout government. Agencies outsource functions to private contractors because it's easier and cheaper than hiring full-time staff. Over time, the institutional knowledge moves to the contractor. The agency loses the ability to do the work themselves. They become permanently dependent on the contractor. The contractor gains pricing power and influence. With BlackRock, the dependency is particularly acute because the expertise is so specialized. Building a system like Aladdin would take years and billions of dollars. Training staff to use it effectively would take more years. By the time a central bank could replicate BlackRock's capabilities internally, the next crisis would have already happened. So the relationship continues, the dependency deepens, and BlackRock's influence over government policy, not through lobbying or campaign contributions, but through sheer indispensability, grows. Let's talk about the US Treasury Department, because this is where the revolving door spins fastest. Multiple Treasury secretaries have had close relationships with BlackRock. Janet Yellen, the current Treasury Secretary, as of 2025, was paid over $7 million by various financial firms for speeches and consulting after leaving the Federal Reserve, with BlackRock being one of those firms. This isn't illegal. This isn't unusual in Washington. Senior government officials regularly cash in on their expertise and connections after leaving office. But it creates a culture where people in government know that being friendly to big financial firms can lead to lucrative opportunities later. And it's not just about future jobs, it's about worldview. When you're constantly interacting with BlackRock executives, when they're providing the analysis that informs your decisions, when their former employees are your colleagues and advisors, you start seeing the world the way they see the world. Their priorities become your priorities, not through corruption but through osmosis. BlackRock's priority is market stability. They benefit from calm, orderly markets because that's when index fund investing works best. Volatility is bad for their business, so their advice to governments consistently emphasizes policies that maintain stability over policies that might disrupt markets even for good reasons. Is that wrong? Not necessarily. Market stability benefits everyone, but it's worth noting that BlackRock's preferred policies tend to align remarkably well with BlackRock's business interests. Funny how that works. Consider how governments responded to the 2020 COVID crisis. Instead of letting markets correct naturally, which would have been painful but might have cleared out excesses, governments and central banks intervened massively to support asset prices. They bought corporate bonds, guaranteed loans, pumped trillions into the economy. Asset prices recovered within months. Who benefited most from those policies? Asset owners. And who owns the most assets? BlackRock's clients. The policies that BlackRock advised governments to adopt turned out to be incredibly beneficial for BlackRock's business. Again, maybe those were the right policies for society as a whole. Or maybe they were the right policies for people who own financial assets, which is a much smaller group. The access BlackRock has to policymakers is stunning when you map it out. Larry Fink has the personal cell phone numbers of presidents and prime ministers. He's been to the White House dozens of times across multiple administrations, both Democratic and Republican. He speaks at Davos and G20 summits and central bank conferences. When he publishes his annual letter, it makes front-page news and moves markets. Compare that to an ordinary citizen's influence over economic policy. You can vote every few years. You can write to your representatives, who probably won't read your letters. You can protest or organize or advocate. But you're shouting into a void compared to Larry Fink having a private dinner with the Treasury Secretary, where he can explain why certain policies would be problematic for market stability. This is plutocracy, not in the cartoonish sense of rich people directly bribing politicians, but in the structural sense of economic power translating into political power. BlackRock doesn't need to bribe anyone. Their expertise is genuinely valuable. Their advice is often sound. But the fact that they have so much more access and influence than normal citizens makes a mockery of democratic equality. Some defenders of the system argue that this is actually good. Government officials need expertise. Financial markets are complex. Better to listen to sophisticated firms like BlackRock than to populist politicians who don't understand how markets work. Let the technocrats handle the technical stuff. This argument has merit until you remember that technocratic decisions are still political decisions. There's no objective answer to questions like, how much should we intervene in markets, or whose interests should economic policy prioritize? Those are value judgments that in a democracy should be made through democratic processes, not by unelected experts from private firms. The counter-argument is equally strong. Democracy is messy and slow, markets move fast. You need people who can make quick decisions based on deep expertise during crises. If that means giving some power to firms like BlackRock, it's worth it for stability and prosperity. This tension between democratic accountability and technocratic efficiency is one of the fundamental challenges of modern governance. BlackRock didn't create this tension, but they've positioned themselves to benefit enormously from governments choosing efficiency over accountability. There's also the international dimension. BlackRock operates in over 60 countries. They have relationships with finance ministries, central banks, and regulators worldwide. In some smaller countries, BlackRock is bigger than the entire local financial sector. They have more resources, better technology, deeper expertise than the local regulators who are supposed to be overseeing them. How do you regulate an institution that's smarter and more capable than you are? How do you maintain sovereignty when a foreign company has more influence over your financial markets than your own government does? These aren't hypothetical questions. Countries around the world are grappling with them. Some have tried to limit BlackRock's influence through regulation. China, for instance, has been very cautious about letting foreign asset managers operate freely. They want the capital and expertise, but fear the loss of control. Other countries have essentially surrendered. They've accepted that BlackRock and other global financial giants are too big and too important to effectively regulate. Better to work with them than against them. Let them help design regulations that affect them. Hire them as consultants. Hope that their interests align with national interests. This might be the most concerning aspect of BlackRock's government ties. It's not just about the United States. It's about a single firm having influence over economic policy in dozens of countries simultaneously. That's unprecedented concentration of transnational power. Historically, this kind of power belonged to governments and militaries. The British Empire, the US military, the Soviet Union. Institutions that at least theoretically answered to some political authority. BlackRock answers only to its shareholders and the markets. Their allegiance is to capital, not to any nation or people. Some would say that's fine. Capital should be stateless, markets should be global, the era of nation-states is ending anyway. Others see an emerging form of corporate sovereignty that threatens democratic governance itself. By 2020, BlackRock's government relationships had made them untouchable. Too big to fail doesn't just mean they'd cause systemic risk if they collapsed. It means they're too important to government functioning to meaningfully regulate or constrain. They've become part of the state apparatus without any of the democratic accountability that comes with being a government agency. But all of this was happening mostly behind closed doors. Most people had no idea who BlackRock was or what they did. That was starting to change. The backlash was coming, and when it arrived, it came from all directions at once. Chapter 7. The Backlash. The turning point came in 2021. Suddenly, BlackRock was everywhere. On Fox News being accused of pushing woke capitalism. On progressive podcasts being accused of enabling corporate greed. In congressional hearings being grilled by both Republicans and Democrats. They'd operated in the shadows for decades. Now the spotlight was burning. The right-wing attack focused on Larry Fink's annual letters and BlackRock's ESG investing push. Republican state treasurers started pulling billions of dollars from BlackRock funds, accusing them of boycotting fossil fuels and prioritizing climate activism over returns. Texas, Florida, Louisiana, Arkansas. Red states started treating BlackRock like an enemy. The rhetoric was fierce. BlackRock was accused of using retirees' pension money to push a liberal political agenda, of trying to destroy American energy companies, of caring more about Davos elites than ordinary Americans, of being part of a globalist conspiracy to control the economy. Some of this was overblown. BlackRock remained one of the largest investors in fossil fuel companies. They hadn't divested from oil and gas. They weren't refusing to invest in Republican-led states. But perception matters more than reality in politics, and the perception was that BlackRock had chosen a side in America's culture wars. Larry Fink tried to walk back the rhetoric. The 2022 and 2023 CEO letters were noticeably less aggressive on climate. BlackRock started emphasizing that they invest based on clients' preferences, not their own values. They launched new funds specifically for clients who wanted fossil fuel exposure. They tried to calm the backlash. Too late. The conservative movement had identified BlackRock as a villain in their narrative about corporate America being captured by leftist ideology. The attacks continued. State legislators introduced bills to ban state pension funds from using BlackRock. Conservative activists organized boycotts. The company that had thrived by staying out of politics suddenly found themselves at the center of a political firestorm. But here's what's interesting. While Republicans were attacking BlackRock for being too progressive, progressives were attacking them for not being progressive enough. Environmental activists pointed out that despite the climate rhetoric, BlackRock still owned massive stakes in coal companies and voted against aggressive climate proposals. Labor unions criticized BlackRock for voting against worker representation on corporate boards. Social justice advocates noted that for all the talk about stakeholder capitalism, BlackRock consistently voted in favor of excessive executive compensation. BlackRock was being hit from both sides. Too woke for conservatives, too corporate for progressives. The perfect enemy for everyone. Democratic politicians started asking uncomfortable questions too. Senator Elizabeth Warren launched investigations into BlackRock's conflicts of interest with government. How much were they being paid for government contracts? What safeguards existed to prevent insider trading? Why was a private company being given this much power over public policy? Senator Bernie Sanders went further, arguing that BlackRock represented everything wrong with modern capitalism. Unaccountable corporate power, concentration of wealth. Wall Street controlling Main Street. He introduced legislation to restrict asset managers' ability to vote shares in companies where they had overlapping ownership. The bipartisan concern wasn't coordinated, but it was significant. Politicians on both left and right were realizing that BlackRock's size and influence had crossed a line. The company had become too powerful in ways that threatened both capitalism by reducing competition and democracy by concentrating decision-making power. Academic research started backing up these concerns. Studies showed that common ownership by large asset managers like BlackRock was associated with higher prices in competitive industries. When the same investors own United and Delta, both airlines have less incentive to compete on price. When the same investors own all the major banks, those banks have less incentive to undercut each other. The result is oligopoly behavior, even in supposedly competitive markets. Other studies found that the rise of passive investing was changing corporate behavior in problematic ways. Companies cared less about operational excellence and more about financial engineering, less about innovation and more about share buybacks. Because index funds couldn't sell even if a company underperformed, managers had less accountability. BlackRock defended themselves by pointing out that they're fiduciaries, legally obligated to act in their clients' best interests. They argued that stewardship and engagement with companies was actually beneficial, preventing the kind of short-term thinking that leads to corporate scandals. They emphasized that they offer both ESG and non-ESG funds, letting clients choose based on their values. The defense was technically correct, but missed the larger point. The issue wasn't whether BlackRock was breaking any rules. The issue was that the rules themselves were inadequate for dealing with a company of BlackRock's size and influence. The regulatory framework was built for a world of smaller, more numerous financial institutions. It hadn't caught up to the reality of massive asset managers controlling significant percentages of entire markets. International backlash was building too. The European Parliament held hearings on BlackRock's influence over European corporations. The European Central Bank faced criticism for relying too heavily on BlackRock during the COVID crisis. Some members of Parliament demanded that BlackRock be classified as a systemically important institution requiring special oversight. In Asia, governments were becoming more wary. China placed restrictions on foreign asset managers' ability to operate freely. Japan started encouraging domestic alternatives to American-dominated index funds. Countries that had welcomed BlackRock's capital were now questioning whether the costs, in terms of loss of control over their own corporations, were worth the benefits. The criticism extended beyond politics into culture. Documentaries and investigative journalism pieces started appearing, exposing BlackRock's influence to mainstream audiences for the first time. The company that had operated in obscurity suddenly had a public profile, and it wasn't flattering. Social media amplified everything. BlackRock became a villain in both right-wing and left-wing conspiracy theories. Some accused them of being part retrie continue edit of a globalist cabal trying to destroy American sovereignty. Others accused them of enabling billionaire wealth extraction from working people. The truth was more mundane than either conspiracy. They were just a very large company that had gotten too powerful. But nuance doesn't spread on social media. You see, what made the backlash so effective wasn't that it was coordinated. It was that it came from genuinely different concerns that all pointed to the same problem: concentration. Too much money controlled by too few people, making too many important decisions. Environmental activists were upset because BlackRock's climate commitments were all talk and no action. Conservative states were upset because even the talk was too much. But both groups agreed that one company shouldn't have this much influence over corporate behavior across the entire economy. Progressive politicians were upset because BlackRock represented Wall Street dominance over the real economy. Conservative politicians were upset because BlackRock seemed to be imposing cultural values through economic pressure. But both groups agreed that the revolving door between BlackRock and government was corrupting the policy process. Competitive markets advocates were upset because common ownership reduced competition. Consumer advocates were upset because the result was higher prices. Labor advocates were upset because workers had no voice, while BlackRock had enormous influence. But everyone agreed that the current situation wasn't sustainable. The backlash wasn't destroying BlackRock. Not even close. Money kept flowing in. Assets under management kept growing. The index fund business model was too attractive for investors to abandon just because of political controversy. Most people investing in BlackRock funds had no idea about any of this and wouldn't care if they did. They just wanted low-cost diversification. But the backlash did accomplish something important. It ended BlackRock's invisibility. For 30 years, they'd been able to grow and accumulate power while barely anyone noticed. Now everyone knew who they were. Now every move they made would be scrutinized. Now they had enemies actively working to constrain their power. BlackRock responded by doing what large corporations always do when facing backlash. They invested heavily in public relations, lobbying, and reputation management. They hired more communications staff. They became more active in defending their record. They emphasized their positive contributions to the economy and financial system. Larry Fink started doing more media appearances, trying to explain BlackRock's role in friendlier terms. He positioned himself as a responsible steward, trying to balance competing interests: climate activists and fossil fuel advocates, workers and shareholders, long-term value and short-term returns. He portrayed BlackRock as pragmatic centrists, trying to do the right thing in a polarized world. Some found this convincing. Others saw it as corporate spin masking the fundamental problem: that no private company should have this much concentrated power, regardless of how responsibly they claimed to use it. The regulatory response was slow and fragmented. Some states passed laws restricting how state pension funds could use asset managers with ESG policies. The SEC proposed new rules around proxy voting and conflicts of interest, but implementation was delayed by lobbying and legal challenges. Congress held hearings but couldn't agree on legislation. International bodies discussed the issue but took no concrete action. This is typical of how democracies respond to corporate power. Everyone agrees there's a problem, but disagreeing on the solution means nothing changes. Meanwhile, the company keeps growing, keeps accumulating power, keeps embedding itself deeper into the infrastructure of the financial system. By 2024, the backlash had become noise, still present, still generating headlines, but not actually stopping BlackRock's expansion. They'd survived the scrutiny. They'd weathered the criticism. They were still standing, still growing, still influential. If anything, the controversy had made them more famous, which brought even more assets under management from investors who liked their size and stability. The backlash revealed something uncomfortable about modern capitalism. Even when everyone recognizes that a concentration of power is problematic, even when criticism comes from across the political spectrum, actually doing something about it is incredibly difficult. BlackRock wasn't breaking laws. They were just very good at operating within the system. Stopping them would require changing the system itself, and that's much harder than criticizing one company. What the backlash did succeed in doing was changing the conversation. Before 2020, almost nobody talked about asset manager concentration as a problem. Now it's a regular topic in economic and political discourse. Academic researchers are studying it. Policymakers are at least aware of it. That's progress, even if concrete action remains elusive. The question is, what comes next? Does BlackRock continue growing until they and their competitors control such a large percentage of the global economy that we're forced to rethink how capitalism works? Does regulation eventually catch up and impose meaningful constraints? Does a competitor emerge with a better model that fragments the market again? Does a financial crisis expose vulnerabilities in the concentrated system and force change? Nobody knows. What we do know is that as of 2025, BlackRock is more powerful than ever, $10 trillion and counting. The backlash made them famous, but didn't make them weaker, and that might be the scariest part of the story. Chapter 8, Modern Empire. Let me give you a snapshot of BlackRock today, right now, in 2025, because the scale is almost impossible to comprehend. $10.3 trillion in assets under management. That number is so large it's abstract. Let me make it concrete. If BlackRock were a country, it would have the third largest economy in the world, behind only the United States and China. Bigger than Japan, bigger than Germany, bigger than India. A private company controls more wealth than 190 countries combined. They employ 19,000 people across 65 countries. Those 19,000 people make decisions that affect billions of people who've never heard of BlackRock. They vote on corporate boards that determine environmental policies, labor practices, executive compensation, strategic direction for tens of thousands of companies worldwide. Aladdin now manages over $25 trillion in assets, including money from clients who aren't even BlackRock investors. Over 200 institutions use the platform. It's processing trades worth billions every hour. It's the nervous system of the global financial system, seeing everything, tracking everything, analyzing everything. BlackRock's iShares platform alone manages over $3 trillion. When you buy an S&P 500 index fund through your 401k, there's a decent chance it's a BlackRock product. Millions of ordinary people are BlackRock clients without even knowing it. Their retirement savings flow through BlackRock's systems, voted by BlackRock's stewardship team, generating fees for BlackRock's bottom line. Larry Fink is now 72 years old. He's been CEO since the company's founding in 1988. 37 years running the same firm, watching it grow from 8 people in a borrowed office to the largest asset manager in human history. His personal net worth exceeds $1 billion, but that understates his real power. He controls voting rights for trillions more. The company is now publicly traded, went public in 1999, which means BlackRock has its own shareholders. Want to know who the largest shareholders of BlackRock are? Vanguard and State Street, BlackRock's biggest competitors. And BlackRock owns shares in Vanguard funds and State Street funds. They all own pieces of each other in an incestuous web that makes a mockery of the idea of competition. The 3 firms, BlackRock, Vanguard and State Street, collectively control over $20 trillion. They're the largest shareholders in virtually every major publicly traded company in America and increasingly worldwide. Some academics call them the Big 3 and argue they represent a new form of corporate structure that's fundamentally different from anything that existed before. Think about what this means for how capitalism functions. In classical capitalism, companies compete for customers and capital. The companies that serve customers best attract more capital and grow. Bad companies lose capital and shrink or die. Competition drives innovation and efficiency. But when the same 3 asset managers own significant stakes in all the competitors in every industry, the incentive structure changes. The Big 3 don't benefit from cutthroat competition. They own all the competitors. They benefit from stable, profitable industries with high margins. They benefit from oligopoly, not competition. This doesn't require conspiracy. It's just math. If you own 7% of Coca-Cola and 7% of PepsiCo, you don't want them to have a price war that destroys both companies' profits. You want them to coexist peacefully at high prices and margins. Your voting and engagement will reflect that preference. Even if you never explicitly tell them to stop competing, multiply this across every industry, and you get an economy that's less competitive than it appears on paper. Lots of companies, but fewer truly independent decision makers than ever before. Some economists argue this explains why corporate profit margins have reached record highs while wage growth has stagnated. Less competition means more pricing power, means higher profits for capital, lower wages for labor. BlackRock disputes this analysis. They point out that they're passive investors who don't tell companies how to run their businesses. They argue that their size actually benefits markets by providing liquidity and stability. They emphasize that their low fees have saved investors trillions in costs compared to active management. All of these points have merit, but they don't change the fundamental reality that economic power is more concentrated now than at any point since the trust-busting era of the early 20th century. And unlike the trusts of that era, which controlled single industries, BlackRock and the Big Three control pieces of every industry simultaneously. The technology dimension makes this even more significant. Aladdin isn't just a tool, it's a platform that's becoming infrastructure. More and more of the financial system runs on BlackRock's technology. That creates network effects and switching costs that make it nearly impossible for competitors to challenge them. If you're a large pension fund choosing an asset manager, you're not just choosing based on fees and returns anymore. You're choosing based on technology and systems. Can they integrate with your existing infrastructure? Do they have the risk management capabilities you need? Can they handle your compliance requirements across multiple jurisdictions? For most large institutional investors, the answer is that BlackRock is one of the only firms that can handle their complexity, not because they're the only option, but because they've been at it longest, invested the most in technology, and have the most data flowing through their systems. They've built such a significant advantage that catching up would require billions in investment and years of time. This is how monopolies are built in the modern economy. Not through predatory pricing or exclusive dealing, or the tactics that antitrust law was designed to prevent. Through technological advantage and network effects that make alternatives uncompetitive, even if they're available. Look at where BlackRock is investing for the future. Artificial intelligence and machine learning to improve Aladdin's predictions. Climate risk modeling to position themselves as essential for the energy transition. Private markets and infrastructure investing to capture the shift away from public equities. Retail investing through apps and platforms to reach individual investors directly. Here's something that doesn't get enough attention. BlackRock isn't just dominating institutional investing anymore. They're coming for retail investors too, and they're doing it in ways that make their institutional business look simple. Remember when investing was something you did through a financial advisor or a brokerage account, when you had to actually think about which stocks or funds to buy. That world is disappearing fast. And BlackRock is one of the main reasons why they've spent the last 5 years building direct-to-consumer platforms and partnerships that put their products into the hands of ordinary people, without those people even realizing they're dealing with BlackRock. It's brilliant and slightly terrifying. Take 401k plans, the retirement accounts that about 60% of American workers rely on. BlackRock has become the default option in thousands of company retirement plans. When you sign up for your employer's 401k and choose the target date fund or the balanced portfolio option, there's a high probability you're actually buying a BlackRock product. The plan administrator might be Fidelity or Vanguard or whoever, but the underlying funds? Often BlackRock. This matters because of scale. Americans have over $7 trillion in 401k accounts. If BlackRock captures even 20% of that market, which they're well on their way to doing, that's another $1.4 trillion under management. And it's sticky money. People don't actively manage their 401ks. They set it and forget it. Money flows in automatically from every paycheck. It stays for decades. BlackRock has also partnered with robo-advisors and investing apps. When you use apps like Betterment or Wealthfront or Acorns, guess whose ETFs are often the building blocks of your portfolio? BlackRock's iShares. These apps present themselves as tech-forward alternatives to traditional investing, and they are. But the underlying products are from the same massive asset managers they're supposedly disrupting. The genius here is invisibility. Young investors think they're using cool fintech apps that are democratizing investing. They're not wrong. These apps do make investing more accessible, but they're still funneling money to BlackRock, just through a prettier interface. It's like thinking you're supporting a local coffee shop when you're actually in a Starbucks with different branding. BlackRock has even launched its own direct investing platforms in some markets. In Europe and Asia, they're testing retail investment apps that compete directly with traditional brokerages. The fees are low, The interfaces are sleek and the marketing emphasizes empowerment and financial freedom. It's the opposite of the institutional, buttoned-up image they present to pension funds. This retail push is strategic for multiple reasons. First, it diversifies their client base. Right now, they're heavily dependent on institutional investors, pension funds, sovereign wealth funds, insurance companies. These are great clients, but they're sophisticated and demanding. They negotiate hard on fees. They can pull billions out if they're unhappy. Retail investors are different. They're less price-sensitive because they don't have the bargaining power of a giant institution. They're less likely to leave because the switching costs feel high and the alternatives aren't obviously better. They generate steady inflows from regular savings rather than lumpy institutional allocations. It's more stable, more profitable business. Second, it future-proofs BlackRock's business model. The institutional market is mature. There are only so many pension funds and sovereign wealth funds in the world. Competition for their business is intense. The retail market, especially in developing countries, is still wide open. Billions of people are entering the middle class and starting to invest for the first time. If BlackRock can capture even a small percentage of that emerging market, it's trillions in potential assets. Third, it gives them even more data. Every retail trade, every portfolio allocation, every investment decision by millions of individual investors, all of that flows through their systems. Combined with their institutional data, they're building a complete picture of how money moves through the global economy. Not just the big players, but everyone. What could they do with that data? Predict market movements before they happen by seeing retail sentiment shifts in real time. Identify emerging investment trends before they become obvious. Understand risk concentrations that nobody else can see. The possibilities are staggering and mostly legal as long as they maintain proper information barriers. While everyone focuses on BlackRock's dominance in public markets, they've been quietly building an empire in private markets too. Private equity, private credit, infrastructure, real estate, they're all the asset classes that don't trade on exchanges and don't show up in the stock market. Headlines. This is where some of the most interesting and concerning developments are happening. BlackRock launched their private equity platform seriously around 2012. It started small, a few billion here and there. Today they're managing over $350 billion in private market investments. That's still small compared to their public market assets, but it's growing faster, and the margins are much higher. Private markets are attractive for several reasons. First, the fees are higher. In public market index funds, BlackRock might charge 0.05% annually. In private equity, they can charge 1 to 2% management fees plus 20% of profits above a certain threshold. It's dramatically more profitable per dollar managed. Second, the money is locked up for years. When you invest in a private equity fund, you're committing capital for 7 to 10 years typically. You can't just pull your money out if you get nervous. This gives BlackRock much more stability and predictability in their business. They can plan long-term without worrying about redemptions. Third, private markets are less transparent. Everything in public markets is disclosed, analyzed, compared. In private markets, valuations are subjective. Performance is hard to verify. Investors have to trust the manager's reports. This opacity benefits large established players like BlackRock because their brand and reputation become more important than objective metrics. But here's what's really significant. BlackRock is using their public markets position to build advantages in private markets. They're telling companies, we're your largest public shareholder. Let us help you with private financing too. Let us manage your corporate treasury. Let us handle your pension fund. It's a full-service offering that smaller competitors can't match, and it creates relationships and information flows that compound their advantages. When you're simultaneously a major shareholder, a lender, and an advisor to a company, you have visibility into that company's operations that gives you massive advantages in valuing investments. Infrastructure investing is particularly interesting. Governments around the world need trillions of dollars for roads, bridges, airports, power grids, telecommunications networks. Public budgets are stretched. Private capital is being invited to fill the gap. BlackRock is positioning themselves as the premier infrastructure investor. They've raised massive infrastructure funds focused on everything from renewable energy projects to toll roads to water systems. This isn't just about returns. though the returns can be excellent. It's about owning the physical infrastructure that society depends on. Think about what this means long-term. If private investors own significant portions of critical infrastructure, what happens when there's a conflict between public needs and private profits? What happens when a BlackRock-owned toll road wants to raise prices, but commuters can't afford it? What happens when a BlackRock-backed energy project prioritizes returns over reliability? These aren't hypothetical questions. They're playing out in real time as privatization of infrastructure accelerates globally. And BlackRock is at the center of it, using capital from pension funds and sovereign wealth funds to buy stakes in the roads and power grids and water systems that billions of people rely on. Real estate is another major focus. BlackRock has been buying residential properties, apartment buildings, commercial real estate, industrial warehouses. They're one of the largest institutional owners of single-family homes in America. When you see headlines about Wall Street buying up neighborhoods and making housing unaffordable, BlackRock is often the Wall Street firm being referenced. The company argues they're providing capital to increase housing supply and professional management that improves properties. Critics argue they're driving up prices, converting owner-occupied housing to rentals, and extracting wealth from communities. Both things can be true simultaneously. What's undeniable is that BlackRock's move into real estate represents another expansion of their influence. They already own pieces of the companies you buy from and work for. Now they're increasingly likely to own your apartment building or the house on your street. The landlord-tenant relationship is one of the most fundamental economic relationships. Concentrating that ownership in massive institutional investors changes the dynamics in ways we're only beginning to understand. Let's dig deeper into the climate issue, because this is where BlackRock's contradictions are most apparent and most consequential. Larry Fink's letters have positioned BlackRock as a climate leader. They talk about climate risk as investment risk. They've created ESG funds and sustainable investing platforms. They publish glossy reports about their commitment to the energy transition. They're members of climate initiatives and sign on to international agreements about net zero targets. Then you look at what they actually own and how they actually vote. BlackRock remains one of the largest investors in fossil fuel companies. They own massive stakes in ExxonMobil, Chevron, Shell, BP, ConocoPhillips, and every other major oil and gas producer. In 2024, they held over $100 billion in fossil fuel company stocks. More importantly, look at how they vote at shareholder meetings. Climate activists regularly propose resolutions asking companies to do more aggressive emissions reductions, to stop lobbying against climate policy, to align their business models with Paris Agreement goals. BlackRock votes against most of these proposals. In 2023, BlackRock voted against 77% of climate-related shareholder proposals. They supported some of the softest, least demanding proposals, while opposing anything that would actually force significant change. Their explanation is that they support engagement over confrontation, that they're working behind the scenes to encourage transition. Maybe that's true. Or maybe it's greenwashing, using climate-friendly language for marketing purposes, while maintaining business as usual because that's more profitable. The evidence increasingly points toward the latter. Here's why this matters beyond just hypocrisy. BlackRock's positioning on climate influences how thousands of other investors and hundreds of companies think about the issue. When the world's largest asset manager says climate risk is financial risk, it lends legitimacy to taking climate seriously. But when that same asset manager continues pouring hundreds of billions into fossil fuels and voting down aggressive climate proposals, it signals that the rhetoric doesn't need to match the reality. This might actually be worse than if BlackRock just ignored climate entirely. At least, then everyone would know where they stood. Instead, they occupy this middle ground, where they talk enough about climate to appeal to ESG-conscious investors and avoid the worst criticism, but don't actually do enough to materially impact emissions or accelerate the energy transition. The result is a kind of climate stasis. BlackRock has enough influence that if they fully committed to aggressive climate action, divesting from fossil fuels, voting for strong climate proposals, refusing to fund new oil and gas projects, it would genuinely move markets and accelerate transition. But they won't do that because it might hurt short-term returns and would anger clients who own fossil fuel stocks. So we get performative climate action. Lots of talk, some green funds on the margins, but core business continues unchanged. And because BlackRock is so influential, their approach becomes the template that other asset managers follow. If BlackRock isn't divesting, why should anyone else? If BlackRock is voting down aggressive climate proposals, those proposals must be unreasonable. This is how institutional conservatism perpetuates itself. The biggest players don't want to rock the boat. They benefit from the current system, so they make marginal adjustments and incremental improvements while resisting fundamental change. And because they're so big, their conservatism becomes the market's conservatism. Larry Fink turned 72 in 2024. He's been running BlackRock since its founding in 1988. That's 37 years as CEO of the same company, an extraordinarily long tenure in modern business. The succession question looms larger every year. BlackRock has theoretically been preparing for this transition. They've promoted potential successors into senior roles. Rob Capito, who co-founded the company with Fink, is president. Mark Weidman runs international operations. Rachel Lord heads the Asia-Pacific region. Ben Golub, another co-founder, oversees risk and quantitative analysis. These are all capable executives, but none of them are Larry Fink. None of them have relationships with heads of state and central bank governors. None of them have his stature as a market sage whose opinions move markets. None of them built the company from scratch and understood its culture and strategy at the cellular level Fink does. This creates a real question. How much of BlackRock's success is institutional, and how much is personal? When Fink eventually steps down or retires, does BlackRock continue dominating, or does it become just another large asset manager, powerful but not exceptional? The technology and scale should persist, regardless of leadership. Aladdin will still be Aladdin. The 10 trillion in assets don't disappear. The client relationships and distribution channels remain. In that sense, BlackRock has successfully institutionalized beyond any one person, but influence and trust are harder to institutionalize. Governments trusted BlackRock during crises, partly because they trusted Larry Fink personally. He had credibility earned over decades. He had relationships built over careers. A new CEO won't have that immediately, no matter how competent they are. There's also the question of strategic direction. Fink has been the visionary pushing BlackRock in new directions, into ETFs, into technology, into climate investing, into private markets. He's not just managing the company, he's constantly reimagining it. Will his successor have that same strategic ambition? Or will they be more cautious, more focused on protecting what's been built rather than expanding further? Some observers think succession might actually be positive for BlackRock. Fink has become somewhat polarizing. His climate rhetoric attracts criticism from the right, while his actual voting record attracts criticism from the left. He's made enemies. A new leader could potentially reset relationships and reduce political controversy. Others think it's an enormous risk. Fink is irreplaceable in terms of relationships and reputation. Losing him could create an opening for competitors to chip away at BlackRock's dominance. It might take years to rebuild the trust and influence he's accumulated. The timing is also uncertain. Fink has given no indication he's ready to step back. He seems energized by the challenges facing BlackRock and the financial system. He might run the company for another 5 or even 10 years. Or he might announce his retirement tomorrow. The uncertainty itself creates risk. What's clear is that whenever the transition happens, it will be one of the most watched leadership changes in corporate history. BlackRock is too important to too many people for the succession to go unnoticed. Every decision the new CEO makes will be scrutinized. Every change in strategy will be analyzed. Every hint that BlackRock is becoming less dominant will be amplified. After the 2008 financial crisis, there was supposed to be a regulatory reckoning. Too big to fail was supposed to become too big to exist. Dodd-Frank and similar regulations around the world were supposed to prevent concentrations of financial power that could threaten the entire system. For banks, this partially worked. Capital requirements increased. Stress tests became routine. The riskiest activities were curtailed. Banks had to prove they could survive another crisis without government bailouts. Asset managers like BlackRock, they largely escaped meaningful regulation. The argument was that they're different from banks. They don't take deposits or make loans. They don't create systemic risk the same way banks do. If BlackRock failed, the thinking went, it would hurt their clients but wouldn't threaten the financial system. This analysis was probably wrong. BlackRock is systemically important in ways that go beyond traditional banking risk. Their ownership of significant stakes in every major company means their failure could freeze corporate governance across the economy. Their role in government bond markets means their failure could disrupt sovereign debt. Their technology infrastructure is so embedded in the financial system that its collapse would cause chaos, but regulators never seriously tried to constrain asset manager size or impose the kind of strict oversight that banks face. Some academics and policymakers called for it. Some proposals were floated. Nothing meaningful passed. Why? Several reasons. First, the lobbying. BlackRock and other asset managers spent millions on lobbyists arguing that they weren't systemically risky and didn't need bank-style regulation. They were persuasive partly because some of their arguments had merit. They genuinely are different from banks in important ways. Second, the revolving door we discussed earlier. When the people writing regulations are former asset manager employees or future asset manager employees, they're less likely to write regulations that significantly constrain asset managers, not through explicit corruption, but through intellectual alignment and career incentives. Third, the complexity. Regulating asset managers is genuinely hard. How do you limit their size without preventing people from investing where they want? How do you restrict their influence without interfering with shareholder rights? How do you prevent concentration without picking winners and losers in the market? These aren't simple problems. Fourth, and perhaps most importantly, nobody wanted to reduce market stability or increase costs for ordinary investors. BlackRock's index funds have saved investors billions in fees compared to active management. Their risk management has arguably made the system more stable. Regulating them aggressively might make some theoretical problems worse while creating new practical problems. So we ended up with the status quo. Some disclosure requirements, some oversight of their role as fiduciaries, but nothing that fundamentally limits their size or influence. Nothing that prevents them from continuing to grow. Nothing that addresses the concerns about concentration and power. The result is that BlackRock in 2025, BlackRock is less regulated than a mid-sized regional bank, despite controlling vastly more assets and having arguably more systemic importance. They file reports and follow rules, but there's no meaningful constraint on how large they can become or how much influence they can accumulate. This might be fine. Maybe asset managers truly are different and don't require the same regulatory approach as banks. Maybe the benefits of their scale and efficiency outweigh the risks of concentration. Maybe market forces will naturally prevent them from becoming too powerful. Or maybe we're living through a massive regulatory failure that we'll only recognize in hindsight, probably during the next major financial crisis when BlackRock's role in the system becomes a problem rather than a solution. The troubling thing is that we're running this experiment in real time with the global financial system as the laboratory. If the optimistic view is right, great. If the pessimistic view is right, the consequences could be catastrophic. And we won't know which until it's too late to course correct.